Welcome. Over the last 8 sections, you have built the entire inventory and cost accounting cycle, all the way through to the 16 journal entries that record it. Now, we ask the question every reviewer eventually asks: what could go wrong, and what stops it? In this section, we pair the risks that threaten the cycle with the specific controls designed to defend against them. Think of it as the safety system that keeps everything you have learned honest and reliable. By the end of this section, you will be able to do 5 things. Explain why every control exists as an answer to a particular risk, never as paperwork for its own sake. Identify the difference between preventive controls that stop errors before they happen and detective controls that catch them afterward. Apply these controls across all 6 phases of the cycle. Define the high and medium risks recorded in the risk register, and identify the root cause and the impact behind each one, so you understand not just the name of a risk, but why it matters. Here is the key thing to understand before we go further. Controls come in 2 flavors. Preventive controls are gates: no purchase order without an approved purchase requisition, no goods receipt note until inspection passes. They stop the error from ever entering your records. Detective controls are alarms: monthly variance reports, reconciliations, cycle counts. They assume something might slip through and catch it before it does lasting damage. A healthy cycle needs both, working across all 6 phases. With the new cost accounting focus, the spotlight falls on standard cost integrity, variance accountability, overhead approval, and spoilage classification. Let us now meet the risks these controls are built to defeat. Start at the front door where goods enter. The risk here is unauthorized purchases, buying outside budget with no requisition, which causes budget overruns, unrecorded liabilities, and incorrect inventory cost. The preventive answer is simple but powerful. No purchase order is raised without an approved purchase requisition and confirmed budget, and no goods receipt note is created until the items pass inspection and acceptance, with anything uninspected held in quarantine. The detective backstop is a goods receipt note versus purchase order quantity variance report, reviewed after every single receipt. Without these gates, the wrong quantity at the wrong price flows straight into your inventory before anyone notices. Now a subtle but expensive risk: landed cost understatement. When duties and freight are expensed instead of capitalized into inventory, the inventory is understated, and your cost of goods sold is distorted for the entire holding period of those goods. The preventive control is a clear landed cost policy that defines exactly which costs are capitalizable, applied consistently to every purchase, not case by case. The detective control is a monthly landed cost variance analysis comparing actual to standard. The surprising part is how long this error can hide. Because it touches every unit you hold, a small misclassification quietly warps margins month after month, until someone reconciles the standard against reality. Standards are the yardstick the whole cost system measures against, so their integrity is everything. The risk is an outdated standard cost. The annual review gets skipped, input costs move on, and suddenly your variances are meaningless. Inventory is carried at an incorrect value, and product profitability becomes misleading. The preventive control is authorization. Standard costs must be approved by the finance director before the production year begins, and any update is loaded into the system only after that same finance director approval. The detective control is a standard cost versus actual cost comparison at period end, where a significant gap triggers a formal standard review. In practice, this means no one quietly edits the yardstick. Closely tied to standards is the predetermined overhead rate, the POR. If the POR is significantly wrong, because the volume assumption is obsolete or the overhead budget is inaccurate, you get systematic over or under absorption, and cost of goods manufactured and inventory are materially misstated every single period. The preventive control is that the POR is calculated and approved before the first production run, and is not changed mid-year without authorization. A related high risk is overhead simply not being applied to work in process at all, which understates that inventory and overstates period income. The lesson is the same. Overhead must be approved up front and fully absorbed, or the distortion compounds every period. The bill of materials, the BOM, is the recipe that drives material costing. When the BOM is not updated for engineering changes, you get incorrect cost of goods manufactured, distorted product cost, and unreliable variance analysis. So the BOM is version controlled, and any change requires production planning and management sign-off. On the floor, raw materials are issued to production only against an approved production order, and any requisition above the BOM quantity needs supervisor approval. Without these, excess material walks out under the cover of normal production, and the recipe everyone trusts no longer matches what is actually being built. Accurate accumulation depends entirely on an accurate, controlled BOM. Variances are only useful if someone is accountable for explaining them. The risk is variances that are never investigated, often because there is no threshold or a cultural resistance to explaining numbers. The danger is that systemic problems like BOM errors, pricing changes, or even theft hide inside unexplained variances and go uncorrected. The controls build accountability in layers. All 9 variance reports are distributed to responsible managers monthly. An investigation threshold is set, and any variance above it must be explained before close. Then the finance director reviews the variance disposition before the period-end entry is posted. Each layer names a person, because a variance with no owner is a problem with no solution. Physical control protects the asset itself. The high risk is theft or shrinkage. Without access controls and counting, assets disappear, inventory is overstated, and cost of goods sold is understated until someone finally discovers the gap. A related risk is physical count errors, where non-independent or non-blind counts can even cover up fraud. The defense pairs custody with counting. Count teams are independent of the regular warehouse custodians, and blind counting is enforced so counters cannot simply confirm the system figure. The detective layer is an ABC cycle count program. A items monthly, B items quarterly, C items annually, plus an annual full physical count observed by the auditor. Independence is the whole point here. Valuation is where the balance sheet tells the truth or does not. 2 high risks live here. First, lower of cost or net realizable value, LCNRV, not assessed on time because the review is deferred to year-end while the market moves, which overstates inventory and profit in interim periods. The control is an LCNRV assessment at every reporting date, never deferred. Second, abnormal spoilage capitalized into good output, which inflates inventory and profit until the units sell. The control is that abnormal spoilage is identified and expensed separately. All write-offs above materiality require finance director sign-off, supported by a quarterly obsolescence review against the inventory aging report. Timeliness, not just accuracy, is the watchword. Reconciliation is the safety net that catches whatever the other controls missed. Every month before close, the inventory subledger is reconciled to the general ledger, and the goods received versus invoice received account, the GRIR account, is reconciled with any item over 60 days investigated. On top of that sit reasonableness checks, cost of goods manufactured compared to prior period and budget, gross margin analyzed by product with significant changes investigated immediately, and open production orders reviewed monthly so orders running beyond cycle time get flagged. Here is the mindset shift. Reconciliation is not a clerical chore. It is the last line of defense that turns a pile of detective signals into a clean, trustworthy close. Step back and see the whole map. The risk register sorts threats by level. The high risks are the ones that misstate the financials materially. Unauthorized purchases, landed cost understatement, outdated standards, a wrong POR, theft and shrinkage, late LCNRV, abnormal spoilage capitalized, BOM inaccuracies, and overhead not applied to work in process. The medium risks are real but more contained. Job cost sheet errors, equivalent unit calculation errors, variances not investigated, physical count errors, and an ABC model that is not updated. The discipline of the register is that every risk lists a root cause and an impact, so you treat the cause, not the symptom. That sets up everything we apply next. Let us pull it together. The single most important idea is that every control is the answer to a specific risk, so you should always be able to name the threat a control is defending against. Preventive gates stop errors at the door while detective alarms catch what slips through, and a sound cycle needs both. Authorization protects the integrity of standards, the overhead rate, and the BOM. Independence and timeliness protect physical custody and valuation. And monthly reconciliation is the final safety net before close. Next, in Section 10, we take this whole cycle and learn the 5-step advisory method for applying it to any client and any business model. Thank you for completing this section on internal controls and risk in the inventory cycle.